Hi everyone, in today's video we are going to discuss about consolidation chapter 2, that is important consolidation calculation. In previous video we have completed consolidation chapter 1, that is a conceptual principle of group accounting. Before starting chapter 2, let's take a quick recap of chapter 1. Chapter 1, Conceptual Principle of Group Accounting. Chapter 1 mainly explains the standards governing group accounting. Four key IFRS standards are important: IFRS 3, IAS 27, IFRS 10, and IFRS 12. IAS 27 separate financial statement, IFRS 3 business combination, IFRS 10 consolidated financial statement, IFRS 12 disclosure of interest in other entities. IFRS 3 is used to determine whether a business combination has occurred and explain the accounting at the acquisition date. After acquisition, IFRS 10 governs how consolidated financial statements are prepared. IFRS 12 focus only on disclosure requirements for subsidiaries, associate, and joint agreements. And IAS 27 deals with separate financial statement of parent. In separate financial statement, an investment in a subsidiary, associate, or joint venture can be measured using either three methods: cost method, equity method, and IFRS 9 method. Cost method is investment recorded at purchase price and dividends are recognized as income. Equity method, investment increase or decrease based on investor shares of profit or loss. IFRS 9 method, investment measured at fair value, either fair value through profit or loss or fair value through OCI. Next important concept is definition of a business. A business consists of three elements: input, process, and output. Input, resource like asset or employee; process like system or procedure applied to input; outputs are goods, services, finished good, and final services or investment income. To simplify this assessment, IFRS allow an optional concentration test. If substantially all fair value is concentrated as a single in a single or group of similar asset, the acquisition is not considered a business. Another core concept is control. Has a power over the investee, is exposed to a variable return, can use power to effect those returns. First, we need to check this: whether a business combination has taken place or not, by using concentration test, or if concentrate after that, if concentration test is not met, then we are going to check that input, process, and output test. Three elements. Another core concept is control. Control exists when the investor has power over the investee. Second is exposed to variable return. And third is can use power to effect those returns. In most cases, that happens when the investor holds more than 50% of voting rights. The chapter also explains situation where a parent does not need to prepare consolidated financial statements, such as if parent itself a subsidiary, its shares are not publicly traded, and the ultimate parent prepare consolidated account under IFRS. So I would like to request you, if you have not completed chapter 1, then please go and complete chapter 1 first. Finally, the consolidation procedure involved combining asset, liability, income, and expense line by line, eliminating investment against subsidiary equity, removing intra-group transaction and unrealized profit, and recognizing non-controlling interest. Now let's start chapter 2, Important Consolidation Calculation. So we need to understand the 5 steps of consolidation calculation. First one is identify the percentage of parents. Usually this is given in the question itself. Working 2 is calculate net asset of a subsidiary. Working 3 is calculate goodwill. Working 4 is calculate non-controlling interest. Working 5 is calculate group retained earnings. Now working 1, identify the percentage of parents. It is generally given in the question. They will say like parent acquired 80% of shares in subsidiary. So company A acquired 80% of equity shares in company B. It is like that in the question. Working to net asset or equity of each subsidiary. How to calculate this? Share capital, share premium, all this we have. First, let's start with share capital. 100 we have at acquisition date, at reporting date we have 100. So there is no movement. Share premium we also have at acquisition date 30 and at reporting date 30, so no movement. OCE or revaluation surplus we have at acquisition date 50, but at reporting date it's become 60 now. So movement under this we have 10. Retained earnings we have 90 at acquisition date, at reporting date it become 120. So movement we have 30. Fair value adjustment land 50 at acquisition date, at reporting date 60. So 10 plus movement we have, that is uplift of fair value. Fair value adjustment PPE we have at acquisition date 60, but at reporting date it became 50. So fair value decreased by 10. Additional depreciation on fair value PPE. So once fair value of the PPE has increased, so we need to charge the additional depreciation. How to calculate additional depreciation on fair value adjustment? Extra depreciation equal fair value adjustment on acquisition date divided by remaining useful life on acquisition date. Suppose in the question they are saying remaining useful life of the PPE is 12 years. So based on 12 years, we can calculate like this. 60 divided by 12 equal 5 we have per year. 5 we have, so 5 we have per year depreciation, additional depreciation. So 5 we have per year additional depreciation. Now fair value adjustment on building. 90 we have negative figure at acquisition date. 90 we have reporting figure at, 90 we have a negative figure on reporting date. So movement is 0. How 90 came negative amount? So whenever we have fair value is less than carrying amount, so in that scenario we have 90 negative. In that scenario we have negative figure. Here it is 90. So whenever we have negative fair value adjustment, that means reversal of depreciation there will be. So same as it is, we charge reversal of additional depreciation on building. For example, same reversal on building. For example, we have 10 years of remaining life. So the depreciation will be 9. Same as it is. Just need to reverse it. Okay, now fair value of contingent liability. Here negative figure because liability we have, we need to pay. 60, no change and no movement. Subsidiary unrealized profit on inventory. If subsidiary is a seller. So what is unrealized profit? Unrealized profit we calculate it on the closing stock. Okay. Here. Sub to parent. Unrealized profit on inventory IS2 sales subsidiary is a seller. Will be calculated on unsold portion of profit. For example, profit is 50 million on sale and 40% stock is unsold. So it will be 50, it will be 20 million. So that is written here. Subsidiary unrealized profit PPE sale if subsidiary is a seller. Sub to parent sale unrealized profit on IAS 16 sale will be calculated sale on profit less depreciation charges from the period of sale to reporting consolidation. For example, sale made on 1st of Jan 2025 asset life is 10 years, reporting is 31st December 2025. Profit on sale is 50. So 1 year we have already crossed because we acquire subsidiary on 1st of Jan and now it is 31st of we are preparing consolidation financial statement. So total remaining years we have 9. So 50 multiplied by 9 divided by 10, that is 45. So 45 we have same amount. Unrealized profit on sale. So unrealized profit on PPE sale will always be calculated on the profit portion. Okay, profit portion after subtracting the depreciation. Depreciation will be calculated from the date we acquired the subsidiary at acquisition date. Now total net asset sum we have 231 and at reporting date we have 209. Movement will be negative 21. In net asset calculation, difference between acquisition date and reporting date is also called post-acquisition movement. Same post-acquisition movement we have 21. Negative figure. Post-acquisition movement and allocated between parent and NCI. Because before that we need to check it. Movement in net asset after acquisition represent post-acquisition profit if increase, post-acquisition loss if decrease. In this case, post-acquisition loss 21. Post-acquisition movement and allocated between parent and NCI because it represents post-acquisition loss or adjustment. Allocation and treatment, parent share and NCI share. Reduce group retained earning. Okay, for NCI, reduce NCI. So in pre-populated sheet, we just need to reduce group retained earning, and for the NCI, we just need to remove that percentage of loss we have. For example, in this scenario, decrease we have 21, parent share is 80%. Suppose that. So parent value will be 16.8. So in pre-populated sheet, what we will do, we are just going to type minus 16.8 from the group retained earning and minus 4.2 from the NCI. So now consolidation effect, group retained earning will decrease by 16.8 and NCI will decrease by 4.2. And now pre-populated sheet adjustment. PPE we have, under PPE we have everything, property, plant and equipment. In this I made simple, so I also include land. But in the exam, you may have land separately, land and building and PPE. So they might give you that type, or they can also compress both together. So it's not included in the depreciable item. That's why. But here I have added all those. So under PPE we have 41 adjustment. How 41 adjustment came? Land uplift, then PPE movement minus 10, depreciation 5, reversal of depreciation minus 9, minus 9, and unrealized purchase. That is 45. So compound it all together, it will give 41. 41. So here we have 41 negative. And inventory we have 20 negative figure. We can see 20 negative we have. Just need to subtract 20 from inventory. Depreciation expense we have minus 4. So minus 4 we have 5 we have depreciation and minus 9 we have depreciation in the reversal of depreciation. So depreciation will decrease, means we have less depreciation now, less depreciation value. Before that we have 60, now it became 56. So here expense decreased. Now revaluation surplus, we have fair value of land uplift 50 it was, and it become plus 10 become 90. 30 plus 50 plus 10, 90. So that's how we need to do the adjustment. In the adjustment, we need to type, see it whether PPE include only machine and building or entire land, everything. So we need to check it. Now, consolidated P&L, how it will affect. So this one is consolidated balance sheet item, and this one is consolidated P&L item. So in the balance sheet, you may not have inventory, you will have current asset. So you just need to decrease inventory from the current asset. Now consolidated P&L. Revenue, suppose any X amount of revenue. Cost of sale, unrealized purchase inventory adjustment we need to do. So what we need to do, we need to remove unrealized profit from the, first we need to add it unrealized profit in the cost of sale. Why we need to add it in the cost of sale? Because due to profit, our cost of sale is decreased. If profit will not be there, then that part, profit part, will be considered under cost of sale. For example, selling price is 100 and cost is 80. Profit is 20. So what will happen if we are not removing 20 profit from the consolidation? What happen if we are not going to remove 20 profit from this P&L? So cost of sale will be still 80 and profit will be 20. So what happen when we are going to remove it 20 profit? Selling price is 100, that is fixed. Okay, no change in this. So once we are going to remove profit, it means cost of sale will increase. So that's what we are doing here. 20 cost of sale increase, and gross profit, same profit we earn 20, we are decreasing here. So this is the tally figure. First, whenever we have unrealized profit on the inventory sale, first we increase the cost of sale and then we decrease the gross profit. Now, depreciation, fair value adjustment we have -5, that is depreciation amount, and +9 reversal of depreciation. So -4 negative figure we have depreciation, means we need to subtract -4 from the depreciation amount. Other income, we need to remove it, PPE sale gain. We earn 50 on the PPE sale. Same as it is, we need to remove it from the other income, not from the gross profit. Operating expense, we have X amount, assume it. Now the operating profit adjustment we have -66. Goodwill, fair value of consideration, NCI at acquisition, we need to add it. Fair value of previously held interest under a step acquisition, less fair value of net asset at acquisition. So whenever we have a step acquisition, we need to add it. What is a step acquisition? For example, we have 40% of the company shares. Okay, and now we are acquiring further 30%. So this is called a step acquisition. So under this, we need to add it fair value of previously held interest. In our example, that is 40%. Okay, less fair value of net asset at acquisition of the company which we are acquiring. Goodwill at acquisition date we will get, and we need to subtract it impairment to the date. Okay, so we will get goodwill at reporting date. Okay, NCI is calculated using fair value method, and also NCI is calculated using partial goodwill method. So sorry, it is called proportionate method. Okay, but when NCI is calculated using proportionate method, we call it partial goodwill, and when NCI is calculated using fair value method, we called it full goodwill method. Okay, under full goodwill method, we allocate impairment percent to the NCI as well as, okay, but under partial goodwill method, we do not allocate impairment to the NCI. Okay, because under partial goodwill method, we show the partial goodwill in the consolidation. We do not show full goodwill in the consolidation. Note, if there is any negative goodwill, that is called gain on bargain purchase, entire it will goes to parent only, no matter anything, and it will increase the profitability retained earning to the parent. Impairment loss. Goodwill can be reduced for impairment under IAS 36, but impairment loss on the goodwill are never reversed. Impairment loss. Note, if there is any negative goodwill, that is also called gain on bargain purchase, entire it will goes to the parent only, no matter anything, and it will increase the profitability retained earning to the parent. Impairment loss. Goodwill can be reduced from impairment under IAS 36, but impairment loss on goodwill are never reversed. Okay. Note, if any acquired asset fair value increase after the acquisition date because of event after acquisition, we do not need to increase goodwill. Okay. And that increase is recognized by adjusting the asset revaluation reserve or P&L depending on the accounting treatment, and it will affect further impairment test for CGU and that carry the goodwill. Okay. So here the if any acquired asset fair value increase after the acquisition date, here net asset at reporting date and at acquisition date. So the movement they are talking about here, 21. Now working for NCI calculation. NCI at acquisition, we need to write it their value. NCI percentage post acquisition reserve, same thing. Whatever post acquisition any amount NCI on, then we need to add it. NCI percentage of impairment only on fair value method, we need to subtract it, and NCI on reporting date we will get. So NCI percentage of post acquisition reserve means post acquisition profit, whatever we have increase in asset value post acquisition. So whatever kind of profit and post acquisition reserve we have, we add it here. Full goodwill method include goodwill impairment. Partial goodwill method ignore goodwill impairment for the NCI only. Now working 5 group retained earnings. Parent retained earnings, we need to add that amount. Share of subsidiaries post acquisition profit. Okay, that we need to add it. Working 2. Working 2, what we have here. Post acquisition profit or loss we have. Net movement 21. So we need to add it. Shares of subsidiary post acquisition profit means parent will multiply their percentage with the post acquisition profit. If gain on bargain purchase or negative goodwill, we need to add that amount. Goodwill impairment, we need to subtract it. Unrealized purchase, if parent is a seller, okay, that we need to subtract that value. Unrealized purchase, if subsidiary is a seller, only portion of parent share we need to subtract it. So we will get the group retained earning. Once we will solve the question, we will see the exact calculation how it works. Other component of equity, same we have parent other component equity plus subsidiary post acquisition other component equity. If any change, this will multiply by parent holding. Whenever we will have subsidiary post acquisition OCE, it will multiply by parent holding, same as it is. Share of subsidiaries post acquisition profit multiply by parent holding, that will add it here, and both will after adding both we will get the group OCE. Now calculate the value of NCI in case of profit and loss and OCI. Calculate or adjust the profit or total comprehensive income attribute to the non-controlling interest if relevant to the requirement. Total comprehensive income formula we have profit or loss plus other comprehensive income. Profit or loss whatever we have plus other comprehensive income. We have profit 1000 plus OCI we have 200, it means. So that's why the TCI will become 1200. We need to subtract it this unrealized purchase if subsidiary is a seller. 100 profit, same as it is, it will subtract it from the both. And excess depreciation or amortization, we need to subtract it, same as it is. Goodwill impairment, we need to subtract it. Adjusted profit, we need to do the adjustment. After adding this, we will get 810, and TCI will be, total comprehensive income will be 1010. So the NCI percentage will be always on profit as well as on TCI. So both NCI proportionate will calculate it for both. Note, it means we give profit percentage to NCI from PNL, also from OCI. This is the simple meaning of this entire thing. So here we got the value of NCI, that is here we got the profit of NCI and TCI of the NCI. 202 is total comprehensive income earned by NCI, and 162 profit earned by NCI. Rest the amount we have, that is OCI, and that we also allocate to the NCI. That's why TCI become 202. Now, consolidated operating cash flow adjustment. You know that whenever we have any non-cash expense in the indirect method of operating cash flow, we need to add it. Add back depreciation plus 5. Now we have a reversal of depreciation. What we did in the PNL, we added. Okay. Here we need to do the opposite, because that is income for us. Okay. That will increase our profit. So we need to subtract it. Reversal of excess depreciation. Remove intra-group gain on PP. That is gain. We need to remove it. Inventory unrealized purchase adjustment. Also we took extra amount. That is gain. We need to remove it from the cash flow. Thank you for this video. In next video, we will study chapter 3.